Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. We have a lot to share with you this morning as markets are moving around a little bit as a result of stimulus talks. So let's go ahead and get started. But before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start with our usual market update, taking a look at the broad-based indices, where they currently sit. Most of them are a little stretched here at the moment, so there are some short-term positioning concerns as far as what are equity markets participants looking at here today, especially this week, with where we expect vaccine distributions to potentially start at the end of this week versus the other downside risks that we currently see with this market. We'll review the commodities markets along with rates and the various sectors that are currently moving around, the rotation that we're starting to see within certain sectors, highlight which sectors are strong, which sectors are weak. And then looking at the economic side of things, we wanted to point out that employment data that we saw here last Friday. Markets moved a bit off of that we want to explain how the markets moved off of what looked like fairly bad data coming out of from the employment side of things. And then we also want to take a look at the holiday card spend data. So, how did Black Friday look like, in terms of the consumer spending? How did the credit card numbers look like? Because that gives us a gauge as to whether consumers are spending as much as they were last year. And then we want to share with you a few ideas before we open this up for Q&A here at the very end. So let's go ahead and get started. Now, the primary question that I want to help investors answer here on today's session is really, what are the downside risks of this rally? Because equity markets are largely priced to perfection here. We are pricing in that vaccine distributions are going to start imminently, that they're going to flow through fairly seamlessly throughout the general public, and that we're all going to get lined up and get vaccinated fairly quickly, and that there will be stimulus to follow from that. So the question is, what are the downside risks that we see to this current market rally that seems to be priced to perfection? So my name is Tony Zhang. I'm the chief strategist here at Options Play. And what I want to share with you are my technical charts of the broader markets right now, the economic research that I'm paying attention to, and the ideas that I currently have as a result of that. So we look at the broad-based indices. The SPY is really the broad-based indice that's currently leading the markets higher to all-time highs. And so far, right now, things still look fairly constructive on this breakout here above this 353 recent high and the 360 or 365 all-time high that we put in just a couple of weeks ago on that Pfizer vaccine news. If we look at momentum has largely confirmed the breakout here. Money flow looks fairly positive here. So everything is fairly constructive of the breakout and a continuation higher here. And we're seeing the same thing here on the Nasdaq 100 index, which largely has actually lagged behind the S&P 500 for the month of November, but has now also broken out to new all-time highs. Momentum has actually confirmed those new highs, and money flow also remains positive. So on all accounts, when we look at the broad-based indices, they seem to be supportive of this current breakout and a continuation higher. Generally speaking, from a seasonality perspective, December is one of the strongest months. December is also one of the strongest months on an election year, which is what we're in. So with all of those things, December typically points to what is a strong month, and that's exactly what we're seeing so far from the equity markets. Now, if we look at small caps, now, this is really where it gets interesting because, when the S&P 500 and the Nasdaq breaks out to new all-time highs, many times we see other segments of the markets maybe lag behind, but we're not seeing that right now. We're seeing small caps join in on the rally, rallying to new all-time highs. Momentum is actually a little overbought here on the small caps, but momentum can remain overbought for a long period of time, and that in itself is not a concern necessarily that this can continue to move higher here. Money flow is extremely strong on small caps, and this is actually more of evidence that the equity rally that we're currently seeing is very broad-based and is a healthy market rally, because when you have just the Nasdaq breaking out to new all-time highs and everything else is falling behind, that's not constructive. But when you have the small caps and you have the big cap names all joining on the rally, and you have equal weight as well. So it's not just the few mega cap names, Apple, Microsoft, Tesla, that are dragging the markets higher. All participants in the S&P 500 are equally participating in this rally. That, again, is also the sign of a relatively healthy market rally. And that's what we're seeing here from equal weight, from small caps. So positive money flow, momentum confirming the moves higher here, or at least continuing to support the breakout higher here. So those are the things that we're currently looking at from a broad-based index perspective. The one thing that I do want to point out that has shifted quite a bit here over the past couple of months here is the rise that we've seen in the 10-year yield. The 10-year yield has risen from below 50, just around 50 basis points, to now almost double that, to 93 basis points is where we currently sit at the moment. It has formed a bit of a double top here, just shy of 100 basis points. And so it's moderating just around this 90 or 100 basis point range, which is, from my perspective, the one thing that really changes from the rise in bond yields here is the fact that, investors don't want to hold, U.S. bonds. They're now buying more and more of the U.S. equities. But if we look at U.S. equities, by all means, it's been expensive from a valuations perspective, whether you're looking at PE ratios or any other valuation metric you could possibly think of from an equities perspective. Equities looks expensive. The only valuation where equities looked cheap was really when you compared the S&P 500 dividend yield to, let's say, the 10-year yield. That ratio made equities actually look substantially cheaper. But when you have a substantial rise in yields and a bit of a decline we've seen in the S&P 500 dividend yields, that makes that valuation metric less attractive as well. So that is the one thing that really has shifted a bit here over the past couple of months as bond yields have risen. Is the fact that makes U.S. equities, which largely had when bond yields were extremely low, equity yields are very attractive. Now that bond yields are a little higher, this makes equity yields a little less attractive. So this puts a little bit more of a damper, in my opinion, on equity rallies going forward. So that is the one thing, in my opinion, that has changed quite a bit here. And that rise in bond yields has caused the sell-off that we've seen so far, or rather the sell-off in dollar is causing this rise in bond yields. Now, the sell-off in dollar has been fairly broad. We've seen this across pretty much all major currencies, whether you look at the euro, the British pound, the Canadian dollar, whichever one perhaps that you may follow, or if you just follow the dollar index, we've seen the dollar index break below that major $92 level. Or if you look at assets that are price in dollars, like like gold, like silver, like even Bitcoin, we're seeing some small rallies here in these names as a result of that. Now, the one thing about gold here is just contending back with this 175 support level, which has held for quite some time, which recently broke below that, and then now we're back to retesting 175. The question is whether we can break above 175 and get back into this trading range that gold has been in for a few months, pretty much after that initial rally we had over the summer. So gold is right now contending with that resistance. We've seen the same thing with silver. We see the same thing with Bitcoin at all-time highs. Those assets are now fairly heavily correlated because, again, they're all denominated in U.S. dollars. When you have a sell-off in U.S. dollars, you naturally have a rise in gold, silver, Bitcoin, and these other assets that are denominated in U.S. dollars. But when we look at the VIX here, we've talked about here over the past couple of weeks as far as the shifts that we have seen in VIX, because after the pandemic, the VIX lows were in the low 20s and the highs were in the low 40s or so since the pandemic. Prior to the pandemic, the lows were in the low teens and the highs were in the low 20s or so. So we've had effectively a shift in volatility regime. Prior to the pandemic, during the pandemic. And now the question is, have we entered a new volatility regime going forward, where perhaps the high is now back in this 20 zone and that we're headed lower into the teens? Now, if you think about, where we were, right, prior to the pandemic, most things were fairly predictable in terms of economics, in terms of corporate earnings. And then we had the pandemic that basically threw everything out of the window in terms of our ability to have any sense of predictability, everything from economics to corporate profits. And even now, I would say there are quite a few things that are still quite unpredictable, but we have a much bit better grasp on things in terms of how things are working. And we've passed a few major hurdles that we have never been through, such as when is a vaccine going to come through? How are they going to be distributed? How many are going to be distributed? When is, what is the outcome of the US election? Is there going to be a peaceful transfer of power? We've passed all of those hurdles. And that is part of why we believe that we have shifted volatility regimes again. Now, is the volatility regime that we're going to enter, this new volatility regime, going to look like the volatility regime we had prior to the pandemic? I would say that that's probably unlikely that you're just going to go back to normal. I think we have a new normal, but that new normal will probably look somewhere in between what we saw prior to the pandemic and what we saw during the pandemic. So, this has some ramifications for those of you that are trading options, because you want to know, where is volatility headed? Because that gives you an idea as far as, are you likely going to be favoring buying options or selling options? So from my perspective, when VIX is trading at 22, it still favors selling options. It's relatively high compared to what we saw prior to the pandemic. We do expect that it's going to continue to fall a little bit, but we're starting to see the ratio of, the VIX term structure. If you look out 3-month or 6-month VIX, it's still fairly elevated, meaning investors are still fairly concerned as to what's going to happen 3 to 6 months down the line. Investors seem at the moment, seem pretty calm about what's to happen in the next 30 days, even though stimulus talks, I think, is the biggest concern for most investors, and we're going to discuss that here. But just be aware that, the new volatility regime that we're entering is changing, and that you may have to make some adjustments to your positioning or make some adjustments in terms of volatility assumptions as you go forward. Now, as we were talking before, gold, silver, Bitcoin price in US dollars, the one major asset that many of us, have to deal with every single day is the price of oil, whether you go out and drive or if you, more likely because you drive. The one thing I want to point out here is that crude back at the $45 level again, which has been a major support or resistance level pretty much since December 2018. And what we're back here is at the $45, $46 level as a resistance level. And when we look at what OPEC is currently doing, when we look at the global oil players, from my perspective, I find it hard to believe that oil will break out above this 45, 46 range significantly higher. It may poke its head out a little bit above that level, but I think for now, this is likely going to be a temporary top. So if you're trading energy stocks, if you're trading crude itself or USO or any of the other ETFs that track this oil, be aware of the fact that we're near this $45, $46 resistance level. OPEC is trying to keep oil prices at these levels. They're trying to make it unproductive for U.S. shale producers, whether you're looking at U.S. or Canadian shale producers. They're purposely trying to make it hard for these companies to make money. And that's where a lot of the companies that perhaps when you're looking at XLE, you're probably trading. So be aware of that, that oil prices, first of all, demand for oil is unlikely to get back to where it ever has been. Especially as post the pandemic, we've seen a pretty significant shift and acceleration towards clean energy and away from fossil fuels. So everything from, how much driving are you going to be doing post the pandemic? Are you still going to be driving to work every single day like you were 5 days a week? Unlikely to happen. Are you still going to travel as much? Corporate travel, we don't expect to ever return back to the same levels they were prior to the pandemic. So these are all things that are likely going to keep the demand of oil relatively low. And that, again, is likely what's going to keep oil relatively capped in terms of prices. So when we look at the individual sectors here, there's quite a bit of sector rotation here as well, right? So equity markets have started to get into this grind, if you will, both S&P, Nasdaq. We're not seeing the sharp gains that we have seen all year long. We're seeing these slow grinding days. They're up 0.5%, down 0.3%, up 0.5%. This kind of slow grind that we're currently in. But there are some sectors that are kind of breaking out and seeing a little bit of momentum here. XLC, communications, is really one of the sectors that put in a bit of a, communications put in a bit of a double top here and has recently broken out above that double top. So we've seen this breakout here above the $66 level here on XLC. And what we have here is a fairly, I would say, strong confirmation on both momentum and money flow, providing support of this potential breakout here. And this makes fundamental sense that as we kind of head into a reopening, there's still a surge in COVID cases. This is causing more lockdowns. This is causing people to actually, so for some of the people who have returned back to the office, actually going back home. So, communications as a sector was one of the outperforming sectors as a result of the lockdown. We're going back into lockdown essentially right now, because until the vaccine is actually widely distributed, the number of COVID cases right now is very concerning. So we're actually seeing communications outperforming. So as you're looking at the equity markets, not all sectors are the same. Communications currently outperforming. And we just talked about crude before, XLE. XLE has had a very spectacular run here over the past couple of weeks. Ever since the Pfizer vaccine news, it's risen quite a bit. And now we've reached a bit of a double top here. It's broken out above the 200-day moving average. But we now see a double top forming here around this $40 level here on XLE. So be careful about XLE. I would only look at long positions in XLE if it can break out above this level. But I think what's more likely is to see this moderate and potentially start moving lower. This double top, in my opinion, is one to pay attention to and see if it fades from that level, especially as crude prices fail to continue to move higher here. Another segment of the market, which we want to take a look at some credit card data to support this, is really in consumer discretionary has started to lose some steam and started to lose some momentum. And, I actually think that, Black Friday, Cyber Monday is likely what could be a bit of a temporary peak here for consumer discretionary, as that is the culmination of retailers running sales pretty much from October all the way through November, trying to get ahead of Black Friday, trying to avoid crowds in their stores, running sales all, for effectively what are multiple months. And now that that's over, I think you're going to see a little bit of a drop off here on consumer discretionary spending, especially as stimulus talks are still stalled. The probability now of a stimulus before Christmas is actually declining a little bit here today. There was a lot of optimism earlier, between Friday and today. It seems like that's starting to wane a little bit again, and that's part of why equity markets are a little weak here today. But as you can see here, consumer discretionary making higher highs each week. But as you can see, momentum not confirming those higher highs. Money flow remains fairly strong here right now. But equity markets are making higher highs, but consumer discretionary are not confirming those highs. So we're really seeing a bit of a loss in momentum here on both consumer discretionary and consumer staples. So consumer stocks starting to fall behind, consumer stocks leading the markets higher largely this year, but we're starting to see some of that lose momentum here. But I did want to show you some of the credit card data. This is Bank of America's credit card and debit card spend data. It gives you a good sense for how consumers are spending compared to the same time last year. So some of the headline numbers that I want to show you, the big number is really November 27th, which is Black Friday. As you can see, total card spend, both on the credit and debit card spend, are down from last year compared to last year, but online is still fairly strong here. So, Black Friday was a particularly strong day for online, but brick and mortar was certainly a pretty significant decline. But net, once you include the fact that Black Friday wasn't particularly weak for online, a 44% increase versus last year, but when you put in the net of all the other spending, the entertainment spending, the decline in spending in gas and clothing, in department stores, in general merchandise, these things, when you add all of these things, add all of them up, at the end of the day, we're still seeing a decline here in Black Friday spend. We don't have Cyber Monday spend data yet, but as you can see, leading up to Black Friday, consumer spending was fairly strong. And what we're seeing is that drop off here after, what has been a strong month for retail, because retailers, like I said, have been running sales all month long to avoid Black Friday crowds. They've been just moving their sales up early into the season, and we're now, in my opinion, likely going to see a drop off here. And we'll see here next week if we do see that drop off, or if it remains fairly strong here. But the one thing that really, I think, drove some optimism around the stimulus here that we saw on Friday, that we saw yesterday, was around the payrolls data, because the payrolls data came in substantially weaker than expected. So payroll data has actually been the one bright spot of economic data that we have seen over the past few months. Everything, surprising to the upside. Month after month, we had payroll numbers that were surprised to the upside. But this is really the first month, or last month was when it came in roughly in line with expectations, but this is the first month when payrolls was significantly lower than expectations. We only had about 245,000 jobs when we expected 460,000 jobs. That's a big difference. And this is showing us that the employment gains are starting to slow down, and this is really what drove some of the optimism that Congress was going to act as a result of this to pass stimulus. And there was a bipartisan deal of $908 billion that seemed to have bipartisan support, but it seems like as of this morning, Mitch McConnell has stated that he's not interested in that particular bill, and that really puts this stimulus before Christmas at risk, and that's part of why equity markets, in my opinion, are a little weak here this morning. But the one thing that I do want to point out here is, despite we added 245,000 jobs here in November, what we have seen is a decline in small businesses payroll. So we've actually seen a decline in small businesses payroll. So this is really what's concerning is, small businesses, generally speaking, tend to be more services based. Think restaurants, the cafes, bars. This, as a result of the coronavirus lockdowns, the resurgent cases that we've seen, this has caused a decline in services. So the employment data currently does not look particularly strong right now, and this is concerning to us. And when we talk about what are the risks of this current rally, it's these types of economic data that really puts the risk of 2021 at risk here. So looking at some of the ideas that we have, when we look at the travel industry, it largely looks fairly decimated across the board. But the one bright spot that we do see a little bit now out of the travel industry is hotels. Airlines are still not near back to normal. They're not really growing at a pace that most investors are really looking for. But hotels are seeming to find some ground here. Marriott actually, on their last earnings report, were actually reporting a small profit here. So, hotels looking fairly strong here. Marriott breaking out above this 120 level here and now continuing higher. RSI is persistently bullish here, or persistently overbought, which, it can continue to go on for quite some time here. And money flow out of all of the hotels, Marriott is the only one that's looking somewhat positive here. So, if you look at Hilton, if you look at Marriott, both of them are actually fairly strong here, but Marriott, in my opinion, looking a little stronger and actually turned a profit here last quarter. potentially turning around here. And if you look at the retailers, there are also, some bright spots within the retailers as well, specifically the discount retailers. Kohl's showing quite a bit of strength here over the past couple of days, perhaps a little bit too fast from $30 to $40 in just a couple of weeks. But I do think that this is one of the stocks worth waiting for, looking for a bit of a pullback into this $35 level here before looking for a continuation higher here, because discount retailers, Dollar Tree, Kohl's, these are all stocks that have seen a little bit of life here over the past couple of weeks. This really speaks to just the economic, where we are economically speaking from, at the end of the day, people still need to buy food staples. People are gravitating towards more discount stores, and these are the stores that are seeing further gains here, rather the luxury goods that we have seen that have driven a lot of the gains that we have seen here this particular year. And lastly, Skyworks on the semiconductor space, one of the strongest sectors in the current market right now. Skyworks having consolidated here over the past largely probably, since May, if you will, between this 135, 155 range, looks like it's about to break out here to the upside. This is really a 5G play. If you're looking at the 5G play, whether you're looking at Qualcomm or Broadcom that have seen some significant moves to the upside, Skyworks falling behind here, but potentially playing a bit of catch up here. So this is one that I would pay attention to for that breakout above 155, especially if you get the breakout above this all-time high. I think Skyworks can continue to move higher here and play a little catch up here to the semiconductor space that has been extremely strong here throughout the rally that we have seen. So with that covers what I wanted to share with you here today. Like I said, a lot going around here with the equity markets. Make sure you stay on top of where yields currently sit. I think that's going to be very important, as well as the VIX. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week. Thank you so much.